Hey everyone, happy holidays. I'm back with another holiday chat call, and I want to remind everyone that if you're watching or listening this because it is the summertime and it suddenly appeared in my podcast feed or the YouTube channel, it means you could have listened to it or watched it back at Christmas time if you were subscribed to my email list. So head over to davidcbarnettlist.com to join my email list. And people on the list get first dibs on signing up for these. Joe, are you on the list?
I am on the list, yes.
Awesome. All right. So, what do you want to talk about today?
Um, I am looking at purchasing a company. Right now, I'm an IT director right now, and I've been doing IT work for about 25 years, and I'm kind of a little burned out on that. So I want to move on into business ownership. I've dabbled in business ownership in the past. I've owned a DJ company. I've
Mhm.
um, I've owned quite a bit of rental property, which I sold a few years ago. Um, so I've dabbled in business, here and there, and now I'm looking at maybe taking a bigger leap into a larger entity, and I'm struggling with the I guess the multiples of EBITDA that they're asking for. The industry, I don't know how much I'm allowed to say because I'm under NDA for
Mhm.
some of these entities, so I probably just can't say the name, right? That's about all it amounts
Yeah,
to.
and we can just keep it general. Like, what sort of industry is it in? Is it or just is it a service business, or do they resell things, or they make things? Like, what do they do?
So like I said, I had a DJ company for a while, a few like 20 years ago. This industry parallels that. This is called basically the event production industry. So a
Okay.
corporation would have, an event that the CEO would be speaking to a few hundred people in a in a hall somewhere maybe, and they would rent sound and video and staging and
Okay.
lighting, and we would go in and set all that up for them. So interestingly enough, there's a lot of those businesses for sale right now. So I think that there is sort of like a retirement thing going on in that industry, and it on account of there being so many of them for sale, I've come up with this question, like why I'm seeing some that are two times multiples of I'm get well, they're calling it cash flow, so I'm assuming that's probably seller discretionary earnings.
Probably. Yep.
Um, some are like two or three times, and some are 10 times. So this one particular one that I'm looking at, they're asking $5 million for the company, and that amounts to about 10 times cash flow. I'm struggling with, if I had 5 million, which I don't, but let's say I did, and why would somebody buy this company um, when the EBITDA is about 500,000? I can take that $5 million and put it in a triple rated, B triple
Oh,
rated
hey.
corporate bond.
So there's no question that doesn't make sense, right? And so if you're asking me for the logic of why anyone would do it, nobody will. What what it comes down to is either one of two things. Either the seller has some kind of um, aspirational price, so they need $5 million, or they think they want $5 million is one reason why they're asking $5 million. And there's two kinds of business brokers out there in the world. There are the shopkeepers and the dentists, is the way I categorize them. So if you think about going into a retail store and they say, "Good day, sir, how can I help you?" and they try to help you get what you want, right? That the very accommodative kind of shopkeeper. And they're just saying, "Oh, yes, you'd like to list your business? Great. What do you want to ask?" And that business broker will put it up there. And then the other kind of business broker is the dentist. If you think about a dentist, they look in your mouth and they say, "Here's your problem and here's the solution. This is what it costs, and I can book you next week or tomorrow or whatever." And if you say, "No, no, I don't want that. I want you to just do this," the dentist is going to say, "Well, that's not going to solve your problem. I'm not going to do it." right? So the dentist is an authority and they are an expert. And so those kinds of business brokers would meet that seller and say, this doesn't cash flow, it doesn't make sense. I'm not going to take the listing. Or maybe we could try selling it for 1.5 million, right? If the cash flow is $500,000. And so you get these listings that get out there that don't make any sense. The other thing that it could be is that you know, someone on Twitter once jokingly put that they saw a coffee shop sell for 8 times cash flow. And someone said that doesn't make sense. It could never happen. And I retorted that it certainly could happen if the cash flow was 1/8 of the value of the espresso machine. And so sometimes we get businesses where the cash flow is quite low, but there's a lot of stuff, a lot of equipment, a lot of inventory. And so the owner, this is more seen in industries with heavy equipment like uh, site prep or paving contractors or things like this, where there's a lot of pieces of expensive equipment. The person's going to say, I don't care what the cash flow is. This is what my stuff is worth. Right.
Yeah.
Now, you took a look at this business. Was there any kind of list saying what came with the business?
Yeah, there is about $3 million worth of inventory, and that would be, all this staging material and
Mhm.
trussing and lighting and sound equipment and amplifiers and stuff like that.
Yeah. So if it even if the asking price was 3 million, just the price of the stuff, it would still be overpriced if it's only generating $500,000 of cash flow. Because if that cash flow is discretionary earnings, it means that out of that cash flow, you have to take a wage as the owner manager of the business. And then you have to make your debt service payments, you got to pay taxes, and you also have to cover depreciation, which is always added back to get EBITDA or discretionary earnings. And depreciation is important because it's the way that accountants represent equipment wearing out. And in this industry, you got stuff that needs to be replaced over time. Scaffolding lasts a long time, but I would imagine other technical things are always being replaced, right? And
Yeah.
so even at $3 million, it wouldn't make sense. This would be an example of what I call a zombie business or dead capital, because what has happened here is $3 million has been invested in this business to buy stuff, and they've never been able to generate the appropriate cash flow to justify ever having made that investment. So the next question I would have in looking at a business like that is, do they need all this stuff to do the level of business they're currently doing?
My guess is um, a lot of the older stuff probably no, but
Mhm.
that stuff is probably not worth much.
Yeah, because when we look at like, I actually had this conversation earlier today about a machine shop where the buyer said not all the equipment's being used. And so one of the strategies can often be, I'll buy the business for a lower amount, but you can keep these items and maybe you can sell them and get some more money, Mr. Seller. And that can be a way for you to be more readily able to accept my lower offer. But if it doesn't cash flow, it doesn't make sense for you to do it. And at the end of
Yeah.
the day, any offer you're ever going to make has to be something that works for you, right?
Right.
And let's talk about the customers. So is there any stickiness or any kind of moat to any degree that gets these guys to have their arms around a certain customer group?
There is. They've been around for a long, long time. So they got a great reputation in my area, and on account of that, they do win a lot of business against the competition. So there's a lot of goodwill there. They they do have some contracts in place, and they actually do some big concerts, even, where they're
Mhm.
they're hanging the speakers from the stage, and there's heavy metal bands on the stage and stuff like that. But I'm afraid that I don't have those relationships, nor do I even understand that industry to keep that piece of the business going. But it is very lucrative.
So you mentioned the G word there, goodwill. So goodwill is an accounting term, and it's the difference between the value someone's willing to pay for a business and the value of its tangible assets. So if someone were willing to pay $5 million for this business and there's $3 million of stuff inside of it, then this business would have $2 million of goodwill value. But with a $500,000 discretionary cash flow, I don't think anyone's going to pay 5 million for it. I don't. I would argue that you would have to be willing to sell the stuff at a discount. This thing is worth less than $3 million. And so
Yeah.
that is like the inverse of goodwill. It's negative. It's a discount that needs to be applied. So there's another place where the problem could reside is that somebody may be mixing up their business valuation ideas in this business. So someone might look at that $500,000 of cash flow and think that applying a multiplier to it represents just the goodwill. And then they're adding the value of their stuff. And I've seen that before.
Yeah,
It
that was,
doesn't make any sense.
I
But
watched
if
one of
there's,
your videos on that where you talked about that, all those posts on Twitter that the one guy did, and that was an excellent post where they're adding the inventory plus the goodwill plus the cash flow multiple.
yeah. So if there's a novice involved who doesn't understand these concepts, they may be kind of lumping this stuff together. And, you know, let's say the owner is more of a technical kind of person than a business person. I mean, they may not know that this doesn't make sense. But the best way to handle this is probably not to go make a low ball offer because, you know, even with the reputation, like they're not able to use that reputation in history to produce a cash flow that warrants the investment in the stuff, right? And so the best way, in my mind, to handle this scenario is to say to the broker and just say, look, I've looked at it, I've looked at the cash flow. If I was going to invest some of my money and borrow some at the bank, the cash flow you're talking about is not going to cover my salary and the debt service and the taxes. So this just doesn't make sense. I'd be more than happy to look at buying this business, but you're going to have like maybe if you don't find a buyer, I realize you want to sell it for 5 million. Maybe after a few months, if the seller is willing to reduce the price, you can give me a call and I'll make an offer. But the cash flow has to make sense to me. Um,
It
and the
it's been
next
for sale.
question, sorry,
It's been for sale since before COVID.
yeah.
So
So this is likely an aspirational sort of scenario where the seller wants or needs $5 million and doesn't need to retire and is kind of like they'll leave and sell if somebody gives them this crazy amount of money. To me, it's not a true indication of a motivated seller. Like, um, and if they feel at the back of their mind they can just close it and liquidate it for $3 million, they're probably holding out that maybe some big national company might want to come into the market by buying them. You know, is that a possibility? Are there big national outfits that do this kind of work?
there, like the companies that do like Taylor Swift concerts and stuff like that.
Yeah. So that might be the idea that they're waiting for that strategic acquirer. Um, big, big national companies tend to be run by smart people. Like, I don't see them overpaying. Maybe someone comes along and they could better deploy that equipment. Maybe they could have it moving more to other cities and get more out of it. But with the cash flow he has, I don't see someone willing to pay more than just the value of the stuff. Um, you said that there's a lot of these businesses up for sale. So one of the other concerns that I would have, and I'm not that familiar with this industry, is are there any kinds of big tech changes on the horizon that might be impacting what these people do?
It seems like a lot of them are their early 60s, so retirement is around the corner for them. Um, but there's been a lot of mergers in the industry. So small production companies falling by the wayside, especially with COVID.
Yeah.
They basically had no work for a year and didn't make it. Um, so some of them get gobbled up.
Yeah. So, and 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 to the question I had about the moat or the protectedness, like I've been involved before at events at hotels and conference centers where they have told us, this is our provider for that stuff. You must use them. And it's kind of like a closed shop kind of facility. Like if you want to have speakers and a screen, you've got to call this guy. And then of course you pay through the nose. Right.
Yep.
And so, and I'm sure that there must be some kind of consideration there that that AV companies maybe is paying the hotel or something for that exclusivity. I don't know. But, in this example, one of the questions I would ask is if you wanted to just create this company from scratch, and I'm not generally an advocate of starting businesses, I know it's risky, but it would seem to me that you could get into this industry and buy a bunch of brand new stuff for a lot less than what you're talking about here for some of these investments, right?
Yep, that was on my list of one of the questions. So it almost seems like in this particular instance, there's less of a risk because it's significantly less money that I would have to spend to get into that industry.
Well, and you can also have an advantage of having all new stuff. And I don't know what the market has been like for the people that sell
Davey
this
there.
stuff. Oh, sorry, was there a little hiccup? Am I back?
Yeah, you're back. Did I freeze
Okay.
up?
Yeah, I've been having these little internet hiccups. So I've got to go take a
Yeah,
baseball bat and fix my router. But the Office Space style. But the
yeah,
the thing is, if you started a business like this in this industry, you might be able, for example, to get some great rate on leasing new equipment, right? You might be able to get a promotional lease rate from some of these manufacturers at better than what an SBA loan would be. Like kind of like when car dealers are trying to push certain models. And so I would certainly explore it because you could be in a position where you go out and market yourself and just start acquiring some of that equipment as you need it for the different jobs. And then you can market yourself as being someone who has all new equipment, all the latest technology, etc. Um, because let's face it, you could finance a year of startup losses and be nowhere near the investment that these guys want.
exactly. Yep.
Yeah.
So is there any sense in well, first of all, is it fair for somebody that's purchasing a business to expect a salary of, of course, if they're going to be, I'm buying myself a job, right? I'm going to need a salary and it's going to have to replace what I currently have. Then on top of that, it has to be able to service the debt. Is that an excessive expectation, or does everybody out there that's buying a business have those two factors? It has to, when I bought property, it had to cover the debt. The rent had to
Yeah.
cover the debt.
So I'll just make one little tweak to what you said. So it's not that the business has to pay you a salary that covers your salary needs. It's got to cover a salary that is the market salary in that industry. So if a fair salary for a person managing and running that AV business is 80 grand, then that's the salary that is fair for you to be able to expect. And this is where people that come out of some really highly paid industries have trouble because if they've been earning $300,000 being like a software person at Google or something, it's hard for them to come and buy a business where the salary expectations are much lower. But that's the adjustment. It and so when I talk to those people, I say, look, if you're going to move from being a developer at Google to being the guy that runs the AV company, like if you made that employment move, you would expect a big cut in your salary. It's the same kind of thing when you buy the business.
Yeah. Okay. But it is fair to expect the debt service to be covered by the cash flow of the business.
Oh, absolutely. Yeah. Like, is there a business broker involved in that $5 million listing?
There is, and I've actually met with the owner several times. He's a great guy. I don't know. Yeah, I know if I make an offer, it's going to be an insult to him probably.
Well, I have a really old video from almost 8 years ago on my channel called "Negotiating for Outrageously Overpriced Things." Did you see that one?
No, I'll have to find that.
Okay. So one common strategy is called "I'm an idiot." So what you do is you basically you find out, let's say $5 million. Let's say you were going to put half a million of your own money and you were going to borrow 4.5 million from the bank. Find out what the loan would be, on an SBA loan to do that. And then you go into them and you say, I'm preparing to make an offer on the business, but I'm having trouble and I can't figure a few things out. I'm wondering if you can help me because I must be missing something.
Yeah.
And then you say, you're showing me this cash flow of $500,000. Um, I'm going to have to take a salary of 100,000 and that leaves 400,000, but the payments at the bank are going to be more than that. And that means that I'll be losing money and there's no wiggle room in case there's any kind of downturn. And there's no money to replace equipment that needs to be replaced. And there's no money for taxes because the principal payment on the loan is part of my income. And I'm going to have a tax bill because this is a profitable business. And I can't figure out where I'm making the mistake. Can you show me how the business, how I'm supposed to offer $5 million?
Actually, when I met with the owner and the broker the last time I met with them, I brought that up because the payment, on 4 million or whatever is about $45,000 a month. And I said, how would anybody be able to purchase this and cover that debt? And the answer was, maybe you shouldn't purchase it.
Yeah.
I mean, they didn't say it
So,
rudely, but that was the ultimate reasoning they gave.
yeah. So in,
I
in
don't know if
my
you can hear
mind,
me again.
oh, sorry, there was a little bump. In my
Yeah,
mind, you don't want to commit more than 50% of EBITDA to debt service. So if the discretionary cash flow is 500,000 and a fair market salary for you is 100, that leaves 400,000 of EBITDA. That means the maximum I would want to be making in debt service payments would be $200,000 a year. So if you were going to make payments of $200,000 a year at 0% interest, it would take you 20 years to pay $4 million. So, so if you wanted to make, let's say, a $4.5 million offer on this, that's the way it would have to be. It would
right.
be, okay, I'll give you 500,000 down, and then I'll pay you 200,000 a year for 20 years with 0% interest. And that would be a $4.5 million offer. It would be a little bit of a ridiculous offer,
Yeah.
but that's the only way it would work in my mind.
So that kind of leads me to one of the thoughts I had on saying, basically an earnout. I will be willing to pay you 50% of cash flow every month until X amount of dollars is paid out.
So the difficulty there is that you're giving them almost like an equity interest in the business. They become like your partner because now every decision you make affects how the cash flow is going to be. So if you want to go to the big convention in Las Vegas and you decide to fly business class, they're going to say, "Oh, you just reduced the cash flow." So I'm a big proponent of participating earnout type deals, but it really should be based upon sales. So, like some kind of percentage of top line revenue. This is the way franchisors do it. If you own a franchise restaurant, you're going to pay the franchisor a percentage of sales as a royalty. That would be the way I would suggest it. So you could say, all right, I'll give you like maybe you use the equipment as some kind of basis. You say to borrow some money. So you say, I'm going to borrow $1 million against your equipment in a conventional secured loan. I've got a couple 100,000 of my own. I'll give you this money on closing day, and then I'll give you, 5% of revenue each month for 10 years. And if the business grows and if prices go up with inflation, you'll end up with more money. And if, the business doesn't do that well, then you'll end up with less money. That is making the payout to them very variable. You could probably do a projection, making some assumptions about inflation and give them an idea of what it could add up to. But if they think that a deep pocketed wealthy person is going to come along and just buy it because of who they are, like they're just going to be waiting a long time.
Right.
Yeah.
What makes me mad is one of the times I was with him, I asked him, "What are you going to do if you can't sell this business?" And I forgot what he said, and it makes me so mad because that's such an important question.
Um, most entrepreneurs will just like, how old is he now?
He's in his early 60s, I would guess.
Yeah. So if his true motivation is retirement, um, my experience with entrepreneurs who want to retire is something like this. When I used to have my business brokerage office, um, people that were, told they were had a terrible illness by their doctor, or people that were getting divorced, or people that were totally checked out mentally, they wanted out, or they knew they had to get out because they didn't want their family to have to deal with the issue of the business or anything like that. And they would come into my office and they would say, what do we need? How do we move? And I would tell them what I wanted, and they would come in the next day with a check for my engagement fee and all the documents I asked for. And they would be like, what next? Well, how quickly can we go? Very motivated. A lot of business owners, they've been in their business for a long time. They're very comfortable. A lot of them have paid down debts. They don't have bankers chasing after them. And so even if they're not efficient in the operation of the business, they probably have very good cash flow because they don't have those bank payments and things like that. And they get to call the shots. They're the boss, right? So it can be very nice to have your own business and be in that position. And so a lot of these people don't necessarily want to retire. But what'll happen is as they start to get into those early 60s, their family will start to have this idea that because they're approaching 65 years of age, that they need to then start getting ready for retirement. And so then the family starts to kind of hound them and pressure them about selling the business. And so I remember I used to have people come into my office who'd be 60 or 59 or 62. They would come in, they'd be like, yeah, I'm getting close to that age. So, my spouse or my kids are saying I need to come in and talk about selling the business. And I would give them my presentation. I would give them the nice folder that everything went in, that had the name of the brokerage on it and stuff. And they'd go away and I wouldn't see them again. And they would take that folder and they would go home and they would tell everyone they met with a business broker and they were starting to take action upon selling the business. And they would set the folder in a prominent place where everyone could see it. And that might buy them another year of procrastination, right?
Yeah.
And then they would kind of show up 18 months, 2 years later, and they would say, okay, well, let's take a look at this, but I'm only going to sell if I get my price. And so there's no motivation. Like when we talk about compulsion, people needing to do something, I always said that the people that want to retire were some of the least motivated sellers I ever dealt with. Because if they didn't have a health issue or if they themselves didn't really want out, like they had a cushy spot. They were the owner of the business, they made the rules, etc. And so many of the business owners that I helped who really needed to retire were in their mid 70s. And that's when they got to the point where they actually started to get fed up. They didn't want to keep up with things. There were technology changes coming that they didn't want to hassle with. And that's when they suddenly became motivated. And I found those people much easier to deal with as far as getting stuff from them and getting questions answered and stuff like that. So, I mean, it could simply be that this guy's just not that motivated unless someone's willing to put 10 years of profit in his hands. He's just not willing to budge
Right.
yet.
Yeah, that makes sense. That makes a lot of sense. That's probably exactly where he's at. Because one of the things, I mean, that list of that one tweet that you referenced, there's like 20 items on there that brokers make in pricing a business mistakes. This business has hit like 15 of them because they're trying to tell me that, and this is one of the bullet points on that list. They're saying that if I just invest another $1 million in the business, it will. Not sure if you're still there yet. Still there, Dave?
Oh, yeah, I'm here. Sorry,
Okay.
little bump again in the internet. Yeah,
Are you
I
able
have
to
to
hear
call.
me when it locks?
Yeah.
So he said, you put another $1 million in this business because right now he's renting trucks and stuff like that. And if I went out and bought my own truck and I bought my own staging and stuff like that, the business would easily, instead of it being a $3.1 million sales business, it would be a $4 million sales business. So it sounds like he's almost trying to price it based on future revenue. And that would be my money, not his. He shouldn't be pricing that in there.
Yeah, so this is often called good blue sky. So it's like painting this picture of what could be. I've also seen many examples of people who will say, "Well, this business could do this if there was more capital injected." But um, I've made videos about this before about how your down payment just needs to be bigger is one of the things that sometimes people will say. And the problem with that is when you look at a business through a finance lens, the bank money is supposed to be cheaper than the equity money. Like investors always demand a higher rate of return than bankers do because bankers take less risk. They have collateral. In the case of SBA loans, they have government guarantees. They get paid out first if there's a liquidation of a business. The shareholders bear most of the risk and need a higher rate of return. What they're trying to get you to do when they say you need to put more money in is they're trying to get you to put your money in with no return so that all of a sudden the payment fits under the cash flow line. And
Yeah,
that doesn't make sense. Um, you know, they're waiting for a foolish, naive buyer with a lot of money.
yeah.
And there used to be more of those out there, but the internet is kind of cleaning that up.
That's that's so true. That I love finance, so that's one of the things I always work with my COO at my firm, and just to learn. I just want to be part of that because the numbers are so cool. And when I had rental property, it was fun to do all that. And you're right. I mean, if if I can take that, let's say I have 500,000 to put down, and I can put that 500,000 and earn 8% today like that, I better be able to get at least 16%, right, from my investment in this company.
No, I would argue you need to get much, much more than that.
Oh,
So,
really?
so you're talking about return on equity. So the return on the investment, when we say a business is worth three times its cash flow, what that implies is that you need a 33% rate of return for it to make sense to buy the business. So if you buy that business and you borrow three-quarters of the money, right, and you pay 10% interest to the bank, what that does is it allows some of that 33% return on 75% of the money to flow over to the equity. It gives you leverage. You know this from investing in real
David, you
estate.
locked up again.
Oh, sorry. When you can you hear me now? Well,
Yeah. Okay.
when you borrow, say, three-quarters of the price from the bank at 10%, the whole business is generating a 33% rate of return. But now three-quarters of it, you're giving the bank 10%. You get to scrape off that 23% difference on three-quarters of the business, and that piles up onto your equity return.
Hmm.
So the return on your equity is much, much higher. It'd be like 70, 80% return on your equity. You know this from real estate investing, right? You put a little bit of money in, you get a big, in the world of real estate, they call it cash on cash return. It's kind of the same as return on equity,
Yeah.
but it gets boosted up the more leverage and the lower the cost the leverage is, right?
Right.
It's the same thing in business. And so that's the desire of people that get into business is they want to have as big a return on their own money as possible. And it's got to be worth the risk because you're investing in the riskiest asset class there is, which is illiquid, privately owned small business. Um,
Right.
there was a central banker named John Exter in the 1950s at the Federal Reserve, and he created something called Exter's Pyramid of Liquidity, and it's an upside down pyramid. It points down, and his whole idea was that in a financial crisis, people try to get out of their assets and into less volatile or less risky assets. So at the bottom of his pyramid, he put gold because at the time the dollar was gold backed, and then right above gold was like treasury currency notes, like dollar bills, right? And then above that was like government treasury bills, and then it was solid corporate bonds, and then above that it was publicly traded stocks, and then there was a whole bunch, and then real estate was in there somewhere. I forget how it goes, but if you Google Exter's pyramid of liquidity, you see this. Well, the topmost layer of his pyramid was privately owned small business.
Oh, wow.
That he's like, that's the riskiest thing because it's illiquid. You've got to do the work to find one buyer willing to buy it from you. And then they have to be able to gather the resources, debt, their own money, et cetera, to actually do the deal. And if there's a panic or crisis of any kind, it's hard to pull that off quickly. And um, so you're talking about a risky asset class. You've got to get a great rate of return. It's got to be far higher than the rates of return that you would normally see in real estate, for example.
Interesting. I would love to see an example of that. If you could do a video on that, that would be really interesting. Because that
Well,
almost needs to be whiteboarded to see those numbers flow.
it's a good idea. I know I've done these videos with whiteboards years ago, but I haven't revisited it in a long time. So yeah, I'm going to put that on my list.
Yeah. Okay. Well, thanks, David. I think that I'm probably not going to move forward with this. It doesn't sound like I can get
You
the
said there
return.
were others though, right? You said some were priced as low as two times. Like, are there not
Yeah,
some other more attractive opportunities in that field?
there are, but it's not local to me. So there's
Ah,
one out in Denver, Colorado, and I'm in Ohio. So that was and it was priced right. And guess what? It's under LOI now. Like
mhm.
I just tried to ask some questions and he had me sign an NDA and then he told me that it was under LOI. So that
And
be and you
that's
could
what
tell,
happened. That's a seller that's actually motivated, right?
right?
That seller wanted to sell and move on.
Exactly. And there's one in New York, but that's the other one that's 10x cash flow. So I don't know, I just have to wait, I guess, and keep looking. It's either that or an apartment building.
Well, if you like this sector, the other opportunity is just to do a proprietary search. I mean, now that you know that you're looking for like an AV rental event company, you just need the yellow pages. You can find them. I mean, you can reach out, contact companies, tell them you're looking to acquire in that sector. And now that you've looked at a couple of them and you also understand from your DJ business days, what the numbers should look like, it'll be easier for you to analyze and digest opportunities that come to you. The biggest difference between reaching out to people who are not, for sale and dealing with business brokers is that the opportunities that business brokers have some preparation to them. They've been packaged up, the information is put together for you.
Yeah,
And when you approach people that are not actively trying to sell, uh, it'll be harder to get what you want because there may be delays, there'll be financial statements that have not been normalized. You're going to have to kind of do those sorts of things that a broker might do to kind of understand what's going on in the business.
that makes sense.
Yeah.
I Yeah, so that pretty much covers my list.
All right.
So yeah, like one of the things I wanted to say, it like when we did fix and rent or fix and flip type projects in real estate, we would, approach people selling their home, and it was either, it was always like either if it's your price, we're going to do it on my terms. So, I'll pay you your price, but it's going to be over 50 years. Or it was my price, your terms. And that's kind of
Yeah.
the same, uh, what I'm thinking with the earnout for this business. But I don't know if I may shoot the email off as a soft offer and see what he says, because it'll probably be shot down, and then I'm out.
Well, and I have had clients before make sort of those suggestions. Say, look, I'd be a buyer if it was around 3 million, or I'd be a buyer at 2.5, or I'd be a buyer at two, and they say no, and then something happens, right? And you don't know what that could be. Um, you know, people that I work with that do proprietary search, they'll communicate with business owners who say, no, I'm not interested. And then a few months later, they'll get a call back from that person saying, things have changed. Now I am, right? And so it, as a buyer, here's the way that you look at it. Think about it like sales. What you are selling is an opportunity to exit, right? And so just like any salesperson out there who's knocking on doors and making presentations to potential customers, the customers don't always buy. All you can do is present your opportunity and they can choose if they want to participate or not. And there are salespeople out there who, like back in my Yellow Page days, I used to call on some clients year after year after year, and they never bought anything. And then one year I call on them, and all of a sudden there's a change. And now they're open to it and they want to buy something, right? And it's the same sort of thing. Like you just go out there and you present your opportunity to exit, you show people what you're willing to do, and it has to work for you, obviously. And if someone is motivated and the timelines are right, then they can choose to participate. That's the way to look at it. Like, don't look at it like you are, disenfranchised because somebody wouldn't sell it to you under terms that made sense to you. Think about it like a sales role. You're presenting something that people can choose to participate in.
Right? Should I probably should. I'm trying not to make I've already started composing the email, and it's going to be pages long, I think, if I try to describe the reasoning behind,
And
you know.
none of that will work. You can't,
Yeah,
like, I'll sometimes get people who will say, like, in the case of this multiple, like you're saying it's 10 times, right? I'll get people who will try to argue about the multiple, or they'll argue like about the methodology, or they'll say, that's not how you value business. This is how you value business, right? And they'll get into these long explanations. None of that is going to hold any weight. Like they're not going to pay attention. You're not going to convince someone in a logical way. All you can do is present what you can do. So you just say, look, I've looked at it in multiple different ways. If you would be willing to entertain an offer around $2 million, then I could come to the table and do something with you, for example. But otherwise, I'm going to have to pass because I know you're looking for the buyer who will pay 5 million. But if anything changes, please reach back out. I'm more than happy to talk sometime down the road, and maybe even send them an email every 3 or 4 months and
yeah.
just ask if its status has changed or anything like that.
So just short and sweet, basically.
Yeah. Yeah. You just say what you can do. Um, and based on what you've explained, they're not going to accept what you can do right now.
Yeah,
Something has to change.
right.
And you can't make someone change.
No, you're right. Because right now they're like that. He probably has that tunnel vision right now. He sees that condo in the Caribbean or something that costs $3 million, and that's what he's hoping to be able to buy when he sells this business. Who knows?
Well, you know, his plan, if he can't sell it, like I don't know how hands-on he is, but with technology today, I'm meeting more and more people who are making claims that a business is like absentee owned, but it isn't really absentee owned. What's happening is the owner in a place like Ohio is just going to Florida in the winter, but they're bringing their computer with them and they're doing all the work they did in Ohio from the kitchen table at the place in Florida, right?
Yeah,
So they're not really absent, they're just working remote. And more and more people are doing this further and further into those retirement years.
yeah. Okay. All right. Well, thanks, David. I also want to thank you, as do all your listeners. What you do is amazing. I mean,
Thanks.
what you provide for everybody, you give people the confidence they need to at least, take the step, and the knowledge. So that's really awesome what you do.
Well, thank you. I'm trying to help people avoid bad deals.
Yeah,
Um, I've just met too many people that have made missteps because they didn't know something. And if this is what I can do to help save people from that, then it's a pretty easy thing for me to do.
yeah. I mean, you bring an honest approach to it. There's the gurus out there that talk about buying a business with no money down and stuff. And I'll be honest, I listened to a couple of them because there are some ideas in there that I glean from, each video or each podcast I listen to. But every time I watch one of your videos, there's always some little snippet that I learned that I never knew before, and it's awesome. And
Awesome.
I'm hoping from this one, people get that, what we were talking about with the 33% return on equity and stuff.
Yeah. Well, you know, it's risky, right? Like, I mean, you use the example several times of the government T-bills. I mean, there's no risk there. And
Right,
so to choose business over that T-bill investment, there's got to be a significant payoff for taking the risk because
right.
it's like it's a illiquid asset. I remember I've had cases before where people have bought a business and then 6, 8 months later they're like, "This is the biggest mistake of my life. I want to sell it now." It take years to get back out of it, especially with that kind of weird kind of track record. Like buyers are like, "What? You only had it 8 months now? You want out?" Like that seems off to a lot of people,
Yeah,
right?
red flag.
And you know, people often have to hold it for a couple of years just to create a new track record to satisfy that new potential buyer to get a reasonable
Right,
price for it.
right.
Yeah.
Okay, I know, I
Awesome.
know. Yeah, thank you.
All right. Well, happy holidays, Joe. Thanks for joining me today.
Same to you, David. Thank you.
All right. Bye-bye.
Bye bye.